unabashed,
the most unpredictable,
becomes a headline,
the most volatile,
outrageous behavior,
unsubstantiated narratives, a battle of personalities.
Welcome to Grand Tamasha, a co-production of the Carnegie Endowment for International Peace and the Hindustan Times. I'm your host, Milan Vaishnav. The Indus Valley Annual Report, published by Blume Ventures, is an annual deep dive into the Indian macroeconomy, the Indian consumer, and the innovation ecosystem in India. The report has become one of the most highly anticipated reports on the Indian economy, pored over by policy wonks, economic analysts, and India watchers. The lead author of the report is Sajith Pai. Sajith is a partner at Blume Ventures, an early-stage venture firm with offices in Mumbai, Bangalore, Delhi, and San Francisco. Sajith oversees consumer and India B2B investing at Blume, and he's the lead author of the annual Indus Valley Report. Prior to joining Blume, Sajith had a 2-decade career in various corporate strategy roles with the Times of India Group. To talk more about this year's report, Sajith joins me from his office in Noida. Sajith, great to have you on.
Hey, delighted to be here, Milan. Such a pleasure.
So this is the 4th edition of the Indus Valley Annual Report, and I think maybe there's no better place to start than the name Indus Valley. It's actually something that you and your co-authors talk about briefly in the introduction. But for the benefit of our listeners, tell us a little bit about kind of what, quote unquote, Indus Valley represents. I mean, beyond the Silicon Valley analogy, there seems to be something more behind it.
Well, to be honest, when you're looking for a word which kind of tried to get the Indian startup ecosystem as a collective term together, we thought of all the usual ones, starting with Silicon, but this Indus Valley thing just clicked because it's not like the US where it's all concentrated in one geographical area. Yes, of course, Bangalore dominates, but it's not only in Bangalore. It's there in Gurgaon, it's there in parts of Bombay and all that. So looking for a word which has India to it, and I thought of Indus Valley as just a kind of a pun. Unlike Silicon Valley or Silicon Glen or what have you. So it was just one of those things which just clicked. And a lot of people now come. In fact, I get some funny tweets which say that the Indus Valley Report has nothing to do with Indus Valley as such, which is true. Yeah. So that's really the story behind the name. Yeah.
So this is the 4th edition of the report. Each passing year, Sajith, it seems to get more and more media and popular attention. I wonder if you could, kind of take us back to 2022 when you put out your first report. What were you and your colleagues hoping to do with this report, and how, if at all, have your objectives kind of changed or evolved over time?
Oh, well, when we started the report, and mid 21, late 21, when we really started working on the report, and published in early 22. At the time, we didn't anticipate it become this big. The goal was to do an Indian version of a very popular report, which doesn't get published now, called the Mary Meeker Report. So Mary Meeker is a VC. She's worked with Kleiner Perkins, and now she runs something called Bond Capital, which is her firm. Mary Meeker, since late 90s, used to publish this annual report, and she's put out all these charts, and sometimes the report takes 300 pages, sometimes 100 pages, and it was very popular. And sort of folks would reach out to me and say, "Hey, this Mary Meeker report, there's nothing on India, barring one year where they had 20 pages, 2017 when Geo happened. There's nothing on India." And I would keep getting this comment, and in fact, then I thought, should I do something like that for India, because there seems to be a slot, and that is really what I was aiming for, to really create a report which would be like the Indian version of the Mary Meeker report, to be honest. And in 22, when it launched, because the Meeker report was still kind of there, now people have forgotten the Meeker report. People used to say that, oh, this is like the Mary Meeker report, and then next year someone says it's even better. And now, of course, people have forgotten that. So that is the truth. And if you ask me, at that point, and really the way the report is structured, India as well as Indus Valley, it has both these sections, it was aimed as much at a Western investor who was evaluating India. And my dream at that point, strangely, was that the Yale Endowment's chief investment officer was sort of the ICP or the ideal customer persona. So you're sort of the target person. And I kind of thought it should be written such that they would feel that we should pick it up and read it and know a little bit more about India. But over the last 4 years, it's evolved in a certain different direction. Now it's really owned and loved by the Indian tech community, and they think it's like their Super Bowl. And like the evening when it gets published, like Bangalore, I get all of these memes and tweets and what have you. So it's sort of interesting now that you asked me. It's a great question, and sort of going back, it's kind of shifted a lot from what the original intentions were, and that's fine. That's how products evolve. But I'm fine with that.
If you look at this year's report, the first section provides a kind of broad macroeconomic account of the Indian economy over the past 5 years, actually. And of course, in that section, you have to deal with the realities and the consequences of the COVID-19 pandemic, which I think all of our listeners will know dealt a very serious blow to the Indian economy. I mean, that's true really of every country, but the Indian economy was especially affected. In response to this shock, we saw the government do a couple of things. They increased capital expenditure. They also increased spending on direct cash transfers, on subsidies, such as food. Then there was a corresponding loosening of monetary policy. All of these things taken together helped to fuel a consumption boom and what we refer to as a V-shaped recovery. One of the things that I found very interesting in your report is that you do identify certain costs to this recovery, right? And I wonder if you could spell out kind of what the costs or maybe what the downsides of the recovery are in your mind.
Yeah. I think the biggest blow that the economy has received since COVID is that it's sharply impacted what we call India 2 or the emerging class. And chances of, I think, the India 1 widening by India 2 kind of growing into India 1, which has been kind of dealt a blow. And this is, I think, the biggest impact that we've seen thanks to COVID. The government kind of response has been, I would say, they've had very tactical responses, and that's not different from how governments all over the world have reacted. But the fact is that the Indian economy I would say, it has its challenges, given that we're a 3.5 trillion GDP economy, but we're also 1.4 billion, so it's about $2,500, $2,700 per capita income. So fundamentally, you need very strong structural changes, and I would say that maybe because of COVID, because of this thing, some of the structural changes haven't happened as fast. What we've had are very tactical plays by the government, whether it is, for example, pushing India firmly into the digital welfare state realm, thanks to UPI and thanks to the need to kind of support the folks. I'd say, for instance, the loosening of the monetary policy and then the subsequent tightening of it, the very sharp rise in unsecured debt, leading to the RBI clamping down firmly on debt, okay, and any growth in credit, which is causing challenges now in terms of growth. So I would say that what we've really seen is that the cost the Indian economy has been bearing is in these tactical playbooks. So each tactical playbook does one thing, but it also leads to second order effects. So India is really seeing these multiple second order effects at play. And in the absence of strong structural reforms on land, for instance, and what have you, you really see these tactical playbooks played throughout. Each has an impact, but the cost is borne out in second order effects. This is really, I think, the cost that we're bearing as well.
So, Sajith, just to pause for a second, you kind of introduced this lingo of India 1, India 2, India 3, which is in some ways, what your report has best known for. Just pause for a second on that and explain to our listeners who may not be initiated. When you refer to India 1, 2, and 3, what segments are you talking about?
India 1, 2, and 3 is actually a very interesting framework. It was actually devised by Kishore Biani, one-time retail czar who fell on bad times subsequently. He was an astute observer of the economy, and I read this first in his book. What I did is somewhere in the late, uh, like, uh, late part of the last decade, around 2018 or so, I wrote this article where I kind of looked at the economy, Indian economy, and the consumer base and divided it into these three Indias. India 1 is about 10% of the country, so about 30 million households, 120, 130 million people. Uh, and it's hard to kind of get exact data on everything, but roughly about 10% of India. And they, I said, account for a majority, as much as two-thirds of discretionary spends in India. And their per capita income really puts them in the lower rungs of OECD countries, or just what enough to categorize them as a high income country for the World Bank's definition. So something like $14,000, $15,000 per capita income. Now, think of them as a Mexico in India, really, right? Like 140 million people, Mexico-sized GDP in India. India 2 is the next tier, really, and India 2 is I would say about 300-ish million large, 70 million households, and they roughly, it's like Indonesia size, but the Philippines is per capita income, which is about $3,000. They're the emerging India, and they consist of, for instance, a Swiggy rider who's trying to kind of work and, or it could be a government, lower level government officer, or it could be like a peon working in, etc., or a very small businessman running a retail store. So that's India 2, and India 3 is about a billion large, and they are poor, and their per capita income, I mean, is really around $1,000, right? And so if you look at it, there's what 130, 140 million India 1, and there's another 300 million India 2, and there's about a billion large India 3. And the way kind of calculated this is to really work backwards using data on, for example, I looked at credit card. Credit cards, about 40 million people in India have credit cards, right? That's it. About 120, 130 million credit cards in circulation, but only 40 million people have credit cards. Cars, very similar number. Mutual fund owners, slightly larger now, but and so on and so forth. So when I looked at this, when it came to this number of 30, 40 million as base for anything which involves discretionary income spend, and that's how I kind of work backwards to say this is really the base for Indian startups to target. This is sort of the native base for Indian startups to target. And the entire framework, India 1, India 2, India 3, was created for startups to kind of estimate their market sizes for. I'm not a macroeconomist, and at no point did I sit and calculate the income percentiles and deciles and kind of work it with all. India 2 came from looking at data around UPI, WhatsApp, and also, for instance, I looked at two-wheeler ownership, and then I worked backwards to say, well, this is sort of where consumption spend sort of end, and I would say India 2 would constitute pretty much about a third of discretionary spends, right? And India 3 really doesn't have too much on the discretionary spend. Sometimes they have to dip into their own savings. And some of this data is corroborated by Bernstein. ICE 360 has their own data. They don't match directly, but these are like thumb rules. And this is not official statistical reports, etc. These are thumb rules and like frameworks created to serve the Indian startup founder. And so I think I've gone on for a bit too long. I'm going to kind of draw you back into the conversation, but I hope it gives you and your listener the flavor of what India 1, 2, and 3 are.
This is George Perkovich, For 3 decades, the Carnegie Nuclear Policy Conference has helped government officials, journalists, NGOs, industry, scholars, and students to debate and understand the latest risks and possible pathways to managing them. This year's conference will be held on April 21 and 22. Registration is open, but seating is limited. For more information on the program and to register, go to carnegieendowment.org/NPC2025.
No, I think it's very useful because as you describe in the report, you have these three segments. You have India 1, which is the kind of consuming class. You have India 2, which is the kind of Indonesia analog, if you will, the aspirant class. And then you have India 3, which, in socioeconomic terms might look a lot like sub-Saharan Africa, which you call unmonetizable users, right? Which is essentially people who don't have the kinds of incomes who can spend on discretionary goods, right? I mean, they're leading a kind of hand to mouth or almost subsistence kind of living. Coming back to the previous discussion on COVID, I mean, just to kind of bring everything together, it seems like one of the findings of the report is you had this COVID shock. India 1 has savings, they have assets, they're able to ride out the storm. India 3 gets welfare, right? They are the beneficiaries of things like the Food Security Act, right? PDS and so on. It's really the second tier, the middle tier that got squeezed. Is that a correct kind of broad statement?
It's a reasonable statement. India 3 has also got squeezed. While they do get welfare, India 2, some parts of India 2 also get welfare. It's hard because welfare is so large in India, and so they would also get some welfare funds. I would say that India 2's challenges have been that India 2 is an ascendant class, right? It's a rising class, and they have aspirations and extra. They haven't grown as much, and they aren't able to move into India 1. You see this in two-wheeler data, two-wheeler sales. Two-wheeler sales haven't come back. In fact, it's well below, I think it's around 2017, 2018. In India 2 has also been powered by, I would say, borrowings. What saved India 2 to a certain extent is that because they're not as heavily supported by welfare, because they're not able to benefit from rising incomes, they've, however, gone on a borrowing binge. And some of RBI's concerns exactly come from that. Because why have unsecured loans grown in India? Because secured loans need collateral, and that collateral, and even for instance, this whole being seen like a state, right, where you have a lot of data on you and you have a lot of stuff. All of that is largely India 1 really has the data. So even though thanks to Aadhaar and thanks to a lot of things, like India 2 is beginning to be seen like a state, they still don't have regular income flows that make them attractive to lenders, and hence they've had to rely on a lot of small ticket personal loans, which has really boomed in India. So I would say that's sort of how it's sort of savings, unsecured loans to a certain extent, as well as some welfare savings, and finally there's welfare savings and a little bit of unsecured loans. So that's how the three classes have really been driving their consumption.
So let me come back to the macro environment for a second, which is, there's this divergence, right? Or I guess a kind of tale of two narratives, right? There are a lot of backers of the government, economists, others who are quite optimistic and say, look, we're in the middle of what is a cyclical slowdown. That's being further fueled by global uncertainties, not least by President Trump's tariff threats. But ultimately, this is just a cyclical slowdown. The fundamentals are pretty good. There are some critics who believe actually this is maybe a more enduring structural slowdown. It has a lot of signs that suggest that, in fact, this may have even predated the COVID-19 pandemic. Do you have a view on, whether this slowdown that we're witnessing now, as evidenced by the most recent GDP print, is indeed cyclical or structural?
Well, I'm not an economist, and sort of out of my expertise area, but I would really say that we've got into, I would say, this 6% growth zone, right? And that's sort of the new Hindu rate of growth, if I may allude to that, and really reflecting what K and Raj said, and nothing to the BJP, just for the sake of for the listeners who are not familiar. So the 3% Hindu rate of growth that K and Raj said has become 6%. But really, if we have to get to where Mr. Modi wants India to be, a Viksit Bharat or a developed country by 2047, 6% growth ain't going to cut it. We need 8, 9, 10% growth. And I would say we're on a 5 to 7%, 6 to 7%. We're on that growth path. I don't think there's any doubt that there's enough momentum in the economy. The base is low enough that you'll get to 5.5, 6%. If you don't do anything stupid, or it's not I mean, Trump doesn't do anything stupid. Let me put it that way. But to get to 8 to 9%, you've got to undertake certain reforms, whether it's land, and, for example, making it easier and easier, for instance, for companies to set up manufacturing units, to be bedeviled by so many regulations, at the state level. It's good to see states getting hyper-competitive about hitting 1 trillion. Maharashtra wants to achieve it. Tamil Nadu wants to achieve it. So the interstate competition is great. I love that. But you need a lot more reforms, and you need some painful reforms. For instance, our currency is still overvalued. So a lot of, but you can't take those changes easily because there will be inflationary, outcomes if you kind of move it sharply. So there is a certain amount of structural reform you need to take. Else, I would say you will fundamentally fall in this 5, 6, 7% growth zone, which I would say we need better. We need to get into that 8, 9 upwards, and because China, when it really boomed during the aughts and the early 2010s, it really grew at almost double-digit growth rates consistently, and we need to kind of get there. So I'm probably not answering your question directly because it's hard for me to say one way or the other. I don't have the arsenal that an economist has to kind of come in and present that. But I would say that we need structural changes for sure in policy and this one, and to kind of get moving specifically on manufacturing.
You brought up the China analogy, which of course, is the natural one. And I think we all kind of use that as a benchmark. One of the interesting nuggets in this report is that compared to its Asian peers, especially China, India has a much lower savings rate. And what's more than that is that savings rate is steadily dropping. You note that the household share of savings has dropped from 84% in fiscal year 2000 to 61%. So more than a 20 percentage point drop in about 23 years. This is FY 2000 to FY 2023. I'm wondering, what are the reasons behind this low and declining savings rate, and what do you think the broader consequences are?
Well, I haven't analyzed the causes very, very, very deeply. I think fundamentally, I think to an extent, China is very unique in the sense that its savings rate, China, Singapore, East Asian countries have higher savings rates. And some of it is the fact that they have higher incomes and sort of that helps them kind of save as well. In India's case, I think we're seeing a fair amount of savings with India One, okay, and some which is getting channeled into the stock market with all the SIPs going there. In the case of India 2, I think it's just a function of India 2's incomes have not risen as much and as sharply as they should have. And fundamentally, it is that. Secondly, I think pandemic was a severe, severe shock. And I think certainly if you look at some of the data before the pandemic, it's not like it was very high before the pandemic. It was declining. The pandemic gave it a more severe shock than it should. And I think specifically, if you look at it, borrowings have been going up, liabilities have been going up, pulling down the savings rate. And it's fundamentally down to why does India 2 and India 3 need to borrow more? And I think the answer is going to be found there. The savings are getting really pulled down by financial savings going down. And when we look at credit too, we're finding that a lot more the credit growth has really been in non-mortgage credit. So clearly there isn't enough income, and some of that income is being supplemented with, I would say, borrowings to finance some consumption. And this is, to me, what is apparent from the data. I probably need to kind of drill down far deeper to look at why, for instance, or where that's going. But to me, this is really the two pieces that they've had to borrow, and that's pulling down the savings rate.
I mean, what's interesting in the data is that you chart a very steep rise in small ticket personal loans, right? So there's been like a 6x rise in personal loans, a 22x rise in the number of loans originated, but the average personal loan size has gotten much, much smaller over time. And just, I think the classification is important. A small ticket personal loan is, I think, below 1 lakh rupees, right? So 100,000 rupees or so.
That's right. There are two factors at play here. One, which we covered, is demand. So clearly there is demand for unsecured loans to finance petty consumption, travel. The other thing could be medical issues, right? Because we're an underinsured country, and while the government is doing stuff on insurance and trying to kind of cover more people, etc., and that's going to help as well. Like a health shock can really lead you into a debt spiral in India, and so some of the borrowings are also going towards that. But there's also a supply side factor, and the supply side factor is really interesting. So somewhere in the middle of the last decade, we had an NPA crisis, right? And which Raghuram Rajan came in, and so what happened really was so much attention went to cleaning up the bad loans on the books of the banks, and typically public sector banks, that they became very cautious about lending out. Okay, and as a result, NBFCs kind of saw this, and banks, of course, the real issue was lending to big corporates, but banks also became cautious in generally lending out, and unless it was really backed by collateral, etc. And as a result, what happened is kind of a window of opportunity emerged for non-banking financial corporations to kind of lend. And specifically, we saw the rise of fintech startups. And fintech startup, what they did is really work together with NBFCs to aggressively lend, and sort of both fintechs as well as NBFCs led to the growth and really bringing together a lot of people who typically were not exposed to, I would say, unsecured lending, right? They were kind of beyond the pale. And because they didn't have collateral, it was not easy for them to get loans. They had to run into microfinance or the lender. But suddenly you had a lot of people willing to offer them loans. And thanks to Aadhaar and things like that, documentation was far easier. The friction to lend improved, reduced. Because the friction to lend reduced, suddenly you had a lot of people taking loans. And then you had this whole thing of someone taking a loan to pay another loan, for instance, right? So there were both supply side as well as demand side factors leading to that. And I think true story of India, like of the last 6, 7, 8 years, India can be understood really through this credit cycle and the growth of credit.
Hey, Grant Tamasha listeners. Thanks for listening to the podcast. Putting this show together each week is a labor of love, but it takes a lot of work to put out a great show every week. If you'd like to support the work we do at Grant Tamasha, please visit ceip.org/donate. Don't forget to subscribe to us on Apple Podcasts, Google Podcasts, Spotify, or on your favorite podcasting platform, so you'll be the first to know when a new episode rolls out. one of the big questions I think in development economics as a field, but certainly is something that applies narrowly to India, is why India hasn't been able to do better when it comes to manufacturing, right? I mean, a lot of people talk about this China plus one moment when firms are looking to de-risk or deleverage. They're looking for another home to invest in manufacturing units, and this is India's time. But your takeaway when you kind of survey the scene is that, India does have a manufacturing playbook and it's good, but you say it's not great. And I'm wondering if you could just kind of look at, take this entire scene and assess it. What are the pros in your view, and what's holding the sector back?
When you look at data, and it's actually interesting that manufacturing share of GDP has steadily trended down since, I would say, the mid 90s, when it kind of peaked at around 16, 17%. And it's down to around 13% today. And that's interesting because the government has been trying to, really, crank up manufacturing, and there's this whole Make in India program, etc. And I think they're doing all the right, all the right noises. The intentions are right, but I think fundamentally, I think there are challenges regarding the factors, which is land, labor, and capital. And what we did is to really look at each of this and look at labor, for instance. When Indian labor is cheap, they are not as skilled and they're not as trained. And that reflects in poor productivity. That reflects in challenges in working with machines, etc. Right? And there are papers, and I don't know who wrote them, but there was this really fascinating paper on how we don't have large-scale manufacturing units in India, but the necessities of regulation, necessities of land challenges, lead them to make subscale units. So
Right. This is a recent paper by the former chief economic advisor Arvind Subramaniam and several of his colleagues. Basically, you have smaller plants.
That is right. Okay, I'd forgotten the name. That's right. You're right. Absolutely right.
Yeah.
So that was a very interesting paper. And so labor is one. Second is land. The ability to get large parcels of land is a rate limiting factor. If you look at the two states which are very well industrialized, Gujarat is clearly the number one example. And Gujarat, for instance, has, I think, manufacturing is more for 38 to 40% of the overall GDP. It's unique. It's very high. And then Tamil Nadu. Both of them do try and make it easy for land acquisition to happen. There are better land records, etc. The ability to buy large chunky parcels of land is there, and which is a challenge in many other states. And there was this fascinating paper by, not paper, but the article by Andy Mukherjee on the great unease of doing business in India. Such a wonderful article where he looked at what it means to set up a plant in Thailand versus India. And he compared all the costs. So it was very instructive. And we kind of use that to make one chart. So it is not easy getting the right land parcel in India, which is just off the highway or on the highway, which has good electricity, which is free of encumbrances and what have you. And finally, there's capital, and capital really is hopefully going to get solved. But challenges, despite what we see about improvement, the lending rates to SME are high, are in mid-teens to higher. And so what it means is that it's expensive to kind of set up, it's expensive to borrow in India. And all of these three factors really choke, the rise of manufacturing. And I think and I think like the big winner really of the China plus one has been Vietnam, and a lot of that is also because I think it's the Chinese units that are coming and setting up, units in Vietnam. So of course they benefited from the fact that the neighbor and this one, but Vietnam also has better skilled labor. Vietnam also has land parcels that are easier to acquire, and Vietnam just makes it easy. And in our case, I think the other challenge has been that a lot of our attention has been to showcase sectors, right? Which is like mobile phones to an extent, still not bad because there's still people needed for assembling, etc. But fact is, a lot of the PLI focus has been on not as much as labor, like for example, footwear, apparel. These are
Correct.
textiles,
Textiles, garments, things of that
which
nature.
like where, for example, which are labor friendly, right? In the sense that they're employment friendly. So sorry, employment friendly is a better word. And what it really means is that because you're focused on these very like I would say high tech sectors, they don't need as many people there, and that's sort of the challenge. And again, I think Arvind Subramanian put out this really wonderful, I don't know if it's a paper or an article about this QOC and the burden that you have to kind of,
Yes, these quality control certificates, which you're required, is a piece in the Business Standard. We'll link to that in the show notes. Yeah.
If you're an apparel company, you need to import inputs, and some of those inputs are taxed like heavily. So overall, the apparel sector and sort of the sectors that would have absorbed a lot more people aren't absorbing enough people. And so I think it's not like these are not well known to people. It's just that we've kind of put together all of this data, and sometimes it looks very stark. And I did get a few clips from my colleagues saying that it looks that depressing, Sajith. And that's what I do. Yeah. So
Well, I mean, so let me try to pull some of these threads together. I mean, because ultimately, this whole debate revolves around the question of employment and jobs, right? And that is clearly one of the most politically salient issues of our time. And one of the points you make in the report is that, look, India has both a disguised unemployment problem as well as a jobless growth problem. And if India as a country wants to take advantage of the so-called demographic dividend, it has to do several things, and they include upskilling the workforce, but also AI-proofing them, which I thought was a kind of interesting phrase. What does that mean in kind of practical terms, right, to a layperson?
I tend to worry a lot about AI, and the reason is that we built one of the star sectors, is this whole BPO ITES sector, and that's really been one of the key engines of our service economy. Uh, and uh, and when I see some of the advances that are happening, and uh, and, and really when you look at, for instance, some of the investments that are going into kind of adding agentic AI, which can take over some of the BPO functions. I think the headwinds are there, and I would say like I tend to worry about that a lot, and I do. I mean, it's hard to kind of AI proof on a like because you don't know what's coming, and you don't know like if if for instance what is getting outsourced, if there's no real cost advantage to outsourcing it, and if it's not going to get outsourced, what's going to be the impact on some of the Indian large companies which employ thousands, hundreds of thousands of people? So I tend to worry about that a lot, and I would say that short term to medium term, I think the impact is could be considerable. Like it is hard for me to kind of say that it will decisively impact the Indian uh, ITES BPO sector, but I think it can. And it's hard at this point to say that you can AI proof. I mean, short of putting restrictions on, like token usage or like sort of like forcibly creating barriers to kind of but then you can only do that with Indian companies. You can't stop people who are outsourcing their this thing to kind of you can't tell them that hey you can't not like kind of stop out whatever. Yeah. So I think I tend to worry about that a lot, and I think the impact on that, I don't know how much to an extent you can AI proof really, but I would say that upskilling and specifically physical manufacturing and increasing skilling would really be advantageous because we're likely to see impact to the service sector. You want manufacturing to then be a sort of a safeguard against it. And manufacturing will mean that you will need both labor-led kind of sectors to kind of take off, as well as there are high-tech sectors where you want more skilled labor force. So I think skilling is really the long-term solution, if you ask me. You've got to have those people being able to work with AI technology and you leverage that AI technology because finally, if you can use that, you need to be in a position to use that technology better. So I know I'm kind of not being as articulate as I'm with charts and slides here, but I am worried about what the impact of AI on services could be, and I am worried about that.
So let me maybe we wrap up by sticking with AI, but taking it in a slightly different direction. You have a section near the end of the report where you ask this question. I think many people are asking this question today of whether India is going to develop its own foundational AI model. And, the emergence of DeepSeek out of China has obviously scrambled the entire sector. People are literally going back to the drawing board, questioning their core assumptions. What's your take on the potential for a homegrown foundational model coming out of India?
We want our shiny new toys and we'll get them. So government has got 18,000 GPU units, and which I think is impressive, and that they've been able to commandeer this. And they've asked, it's sort of like they've asked for some kind of tender, right? For companies to submit their proposals. It's almost like I was chatting with Shruti, I think, and she said it's more like asking for a highway, and it's sort of you're going to get a model. Now, is it going to be like DeepSeek? I don't know. Okay, is it going to be on par with any of those? Okay, you'll get a model, and over time it will improve. It could improve as well, and I think AI sovereignty is clearly a big theme here. And I think the government clearly wants a model. And I think Indian startup founders were here, and some of them are excited to make one. So there's Paras Chopra, for instance. Some say Sridhar Membu wants to create one. So you will see some of these models. How good there is models, we'll see. Will we get a native Indian vernacular language model? I don't know, because you need to pour up enormous amounts of data, which OpenAI has been doing for the last so many years, into some kind of a structure, the thing which, and that I don't know if any Indian company is doing right now. The Indian government could support that, but yeah, I don't think anyone is doing right now. So what you're going to get will be a model, and you will definitely get a native model. I think there's enough momentum behind it. There's enough thing. I'll be surprised if it doesn't happen. As to how should we have had that? Should we have instead focused on clever little applications, which, for example, one idea is to kind of link it to welfare. That if someone is deserving of a particular scheme and is not able to get a scheme, is there a way, for instance, to use AI to communicate and get that delivered? So there is certainly room for many clever little applications across GovTech, Civic Tech, what have you. But we've been very highly focused on having our own foundational model. It seems to be a point of pride, and I think we'll get one.
My guest on the show this week is Sajith Pai. He's a partner at Blume Ventures, an early-stage venture firm. He's also the lead author of the 2025 Indus Valley Annual Report. It's a repository for all kinds of interesting insights and information on the Indian economy, the consumer economy, the future of tech, the startup innovation ecosystem. Sajith, it was really a joy to read this as I was going through it, in a former life, I used to do a lot of teaching in classrooms, and I was thinking that, each one of these slides is like fodder for a research paper for a student to kind of dig in and flesh things out even larger. Thank you so much for putting this together, and thank you so much for taking the time.
It was my pleasure. Thank you for having me on the show.
Grand Tamasha is a co-production of the Carnegie Endowment for International Peace and the Hindu Sun-Times. This podcast is an HT Smartcast original and is available on htsmartcast.com. You can also find us on Apple Podcasts, Spotify, or wherever you get your podcasts. Don't forget to rate and review. It helps others find the show more easily. For more information about the show, to support the work we do on Grand Tamasha, and to find the writing we mentioned on this week's episode, visit our website, grandtamasha.com. Tim Martin is our audio engineer. Mira Verghese is our executive producer. Additional assistance is provided by Annabelle Richter. Thanks for listening, and see you next week.
This was a Hindustan Times production brought to you by HT Smartcast.
HT Smartcast.